Okay, so we're going to start on corporation tax losses tonight. And there are three types of losses you have to look at. You can look at corporation tax losses for a company by itself, terminal losses for a company ceases, and then group losses. If you've got a group of companies, how they can transfer their corporation tax losses between them. But I'm only going to concentrate on just corporation tax losses tonight, and then bring in the terminal ones and the group losses the next night, just so we won't be confusing things. And I'm going to go back over then, do a complete corporation tax question from start to finish. Joe will add backs and everything in it, and go over the closed company surcharge stuff that we done the week before as well. Just do exam questions and then, and hopefully that'll take us up to 9 or after it. Okay, and the corporation tax losses are the exact same as ones we would have learned before. So if you go to page 7 of that handout, okay, I've done it out there on a little, just a bullet point to make it easier to actually learn it. So your corporation tax losses, you have your current year against other trading income, section 396A, prior year against trading income, section 396A, current year then against your corporation tax on a value basis, prior year against corporation tax on a value basis, and you carry forward them indefinitely against income from the same trade. So you have 5 steps to actually do. So the steps in Utilisium, offset against case 1 and trading income in the current year, you go back into your previous year and offset them against your trading income in the prior year. Calculate your tax computation as normal, then calculate the amount of loss needed to settle the corporation tax liability on the current year. So it's your corporation tax liability divided by 0.125, because 0.125 is our corporation tax rate. Then calculate the amount of loss needed to settle the corporation liability in the previous year, and then remaining loss carried forward to a future year. And the important thing in that is, it's the same trade only. Okay, the same trade only. And you follow exactly like that. And the important thing to remember that the year of your loss is your current year. Okay, so when you're starting your loss, looking at your current year is the year of your loss. Okay, this is for your case 1 or 2 losses. And then underneath that, remember current year is the year of the loss. Okay, just, I know it's a bit dark there. We're on the corporation tax notes. Corporation tax losses. It's the very back of the pack. It's corporation tax losses. And then I'm on page 7 of that little section of it. It looks like that. There, just, yeah, that's it there, on that side. Okay, so your 5 steps, your current year, you see how much loss you have, and see if you put it against any other income. Go back then to your second year, or your previous year, see if you put it against income in your case 1 or 2 income in there. Come back into your current year, calculate your corporation tax liability as normal. Then you do your value basis, go back to your previous year, do your corporation tax computation there, and do your value basis, and then anything that's left over, you carry forward to the future year. You've got 2 years is your time limit to utilise losses if the losses occurred in. Okay, so if the year ended December 14, say there I have 12 in there, but say it's December 14, you've got until December 16 to actually claim that loss.
Well, 1.5 at the top there and carry forward indefinitely.
Yeah, so like say you went on to you would have 100,000 loss left over after doing all that. Okay, and you went on to your future year and you only had 10,000 profit. Well, you put 10,000 of that loss coming forward against that 10,000, and you carried the 90,000 that's remaining onto the next year. So you can keep carrying it forward until you actually have it all utilised.
Yeah, time limit, the 2-year time limit, what's the...
Oh yeah, you have a 2-year time limit to go back. Do you know what I mean? Oh. Say you went on to your, say we're doing 14 now, right? Yeah. And you made a loss in that year of say 20,000. Okay, and you didn't do anything, you just submitted your tax return and didn't claim any of the loss against your other income. You came on then inside in 2015, you made another loss. Okay, so, and you can actually now go back to 14 and claim that loss by going back to 13. Okay, it's like what usually happen. You might have your tax return done. You thought you might have been able to carry forward your 14 loss into 15 to make a profit. When you went to 15, you made another loss. So there's no point just carrying forward losses and losses and losses. You go back to your 13 and claim back your corporation tax you've paid, and the same in 14, claim back the corporation tax you've actually paid. Okay, and you use a little loss memo to keep track of the losses used. So we do a little loss memo down our side to keep track of the losses. Then case 5, loss, you can carry back to a case 5 profit arising in an immediately preceding period and only against case 5 only. Okay, so case 5 can only go against case 5. Case 1 or 2 can go against the other incomes on a value basis, but case 5 can only go against case 5. And the thing about a case 5 inside corporation tax is you can actually carry it back, but inside an income tax you can't carry it back. And then a capital loss only against a chargeable gain, and if you don't use it in that year, you can carry it forward against future periods. Okay? Is this ringing a bell from before, yeah? We're going to do questions. The easiest way to actually see this in working. So if we go to page 2, okay, and there's B Limited. See that one there on the top? B Limited makes up its accounts to the 31st of December each year. Recent results are as follows. So we've got 2012 and 2013. We've got trading income, case 3 interest, rental income, and chargeable gains adjusted. We must calculate corporation tax payable for 12 and 13, showing clearly the last memo. So the important thing now is 2013 is our current year, 2012 is our previous year, and 14 would be our future year. Okay, so let's open the sheet here and we'll work through that one. Okay, so this is B Limited. Okay, I'm going to do the corporation tax. Okay, so we're going to do 2012 and 2013. Is that big enough for you? Make it a bit darker there. Okay, so we're going to be doing two alongside each other. So we've got 2012, 2013, and then over the side you're going to have your little last memo. Okay, or if you want to have your last memo on the page next to it, but it's somewhere near. So you have your 12, your 13, and your last memo. Okay, so we're going to put in all your information now first. Okay, so we've got our trading income. So we've got our Schedule D. Case 1 or 2. Let's say case 1. Okay, for 2012 is 12,833. And for 2013, we're going to put that into our last memo. Okay, so our last in 2013. Okay, we're not going to put it into our inside our 2013 year. We're going to put it into our last memo here, 54,205. Okay, we've got Schedule D case 3. Okay, just leave a little bit of space in between because we have to go back and put our loss in, up here. So just leave a little line or two. And that is 4,900. And it's item 13,358. Schedule D case 5 is 3,700 and 4,860. That gives us our total income. Chargeable gains then, we've done that year and we want 425, giving us our total profits. Okay, so you have all your cases of income giving your total income, then your chargeable gains are put separately, which gives you your total profits. Okay, so we look at our first, we'll take it down to page 7 and look at your steps. So our first one, offset against other case 1 trading income in the current year. So we have no other case 1 trading income in the current year, so we don't. So we go back to our prior year. So offset against case 1 trading income in the prior year, and we've got 12,833 worth of profit there. We can actually put our loss against, and that's section 396A. Okay, so we've got our loss. Section 396A. Minus 12,833. Okay, so it comes straight off of there because they're both case 1 sort of incomes. And you must now bring this over to your last memo. So inside here we're going to put in section 396A. 2012 was 12,833. Okay, and just minus your loss off with them. Your loss minus what you've used, bring you down to the loss you have at the moment now is 41,372. Okay, our next step is to calculate our corporation tax liability as normal now. Okay, so going to 13. Calculate my corporation tax liability as normal. Okay, so I've got case 3 and case 5, so adding them together, 3580 plus 4860, giving me a 440, and adding on my 1425 onto it, giving me total profits of 9865. Okay, my taxable then at, remember our case 3 and case 5 are going to be taxed at 25%, and my chargeable gain is going to be taxed at 12.5%. Okay, so I'm going to have 1425 by 12.5%. Okay, and then I'm going to have the remainder 25%. Okay, so my chargeable gain at 12.5%, my other income all at 25%. So your case 3, 4 and 5 are always at 25%. Which gives me the moment €2,288 of corporation tax I owe. Okay, so I go up to my last memo now. Okay, and I have 41,372 worth of losses inside there. Okay, I'm going to see now how much of that loss I need to get rid of €2,288 worth of corporation tax. Okay, so that's your section 396B, current year. Okay, so how much is it again? Sorry, 2288 divided by 0.125. Okay, so take how much your corporation tax liability is and divide it by 0.125. Which gives us 18,304. So to get rid of €2,288 worth of corporation tax liability, I need 18,304 worth of case 1 loss. So just bring down your figure then again, 41,372 minus 18,304. So you've got this 2,3068 worth of loss to be carried forward again. Okay, so you can now enter your computation. So section 396B, 2288. If you want, you can show your little calculation in there again. 2288 divided by 0.125. Or you can show 18,304 multiplied by 12.5%. Probably better. Which brings down to a liability of 0. Okay, so our corporation tax liability is 0. Okay, so that's our current year loss taken care of. So go back now to our prior year and calculate our corporation tax liability again as normal. Okay, so what we got in the previous year, we have 4,900 and 3,700, isn't it? Which gives us 8,600. Our profits are, total profits then are 8,600 because we have no chargeable gains. So it would be 8,600 by 25%. Which is 2,150. Okay, so 8,600 multiplied by 25%, 2,150. So we need to find out now again how much this 2,150 we need, how much of our case 1 loss we need to shelter 2,150 worth of corporation tax liability. So up to our last memo again. Okay, this is section 396B for a year. It's 2,150. So 2,150 divided by 0.125 is 17,200. So we need 17,200 worth of this loss to get rid of 2,150 worth of corporation tax liability. Is that okay? Yeah? So if I go over here then, so 17,200. So my section 396B will be 17,200 by 12.5%, which will be 2150, giving me a stability of 0.
So you do it like that, and then you get a rebate.
Sorry?
You do it like that, you show your work and you send it in and you get a rebate.
Yeah, like if you were on time 14 year now and you saw that you were making a loss again, you'd send in your 13 one to get your 13 loss to get your money back, because you'd have paid your 13 tax, you paid your 12 tax.
You just send it in with them accounts kind of when you're sending in that.
Yeah, it's in little, it's in little computation with it, and there's no problem. I've done it there a couple of years where they wanted to wait and see what the next year was like, and then they made loss, so we went back and actually claimed it. Just say that no. Tonight, what day is today? Is it the 5th, isn't it? Okay, so just practicing it. Oh, I just want to finish that off, sorry. I should have done this 5868 here now. It's the last part of it. It's your section 3961. So section 3961. Okay, and that's carried forward. Carried forward to future years of same trade only. Okay, that's the important thing, of the same trade only.
We should put in the section.
Yeah, you need to know the sections, yeah. But it's okay, it's 396A, 396A, 396B, 396B, and 3961.
Is it 3961 or 396.1?
No, 3961.
Was it?
Yeah.
I was right
Yeah.
to do it because.
It doesn't make a difference anyway. Yeah. Yeah, 3961. So we do another one. And if you go to page 9. Okay, so Cork Limited has the following results for the last 3 accounting periods. So we've got December 12, December 13, and December 14. Okay, and remember, your year of your loss is your current year. Okay, so our loss there, I know it's very small, but the loss is the 100,000. Okay, if you want to put a little brackets on that, the loss is the 100,000 one. Okay, so December 13 is our current year. December 12 is our prior year, and December 14 is our future year. Okay, so the year in December 13 is our current year. The year of the loss is always your current year. Okay, so let's open up a new one for that. That's Cork Limited. Okay, so we're doing 2012, 13 and 14 here now. Okay, and I always find the best thing is actually just put in all your information before you actually start, so you know what they all are inside in the years. So trading income for 2012, so our case 1 is 50,000. Irish rental income is case 5. And again, adjusted is our chargeable gain. Okay, that's our 2012 year. So our case 150, and remember to leave the space so you can actually bring your loss in under the 50,000. Okay, 2.5 for our case 5, and then 4,000 for our chargeable gain. In 13 then we have our 100,000 loss. So we're going to put our 100,000 loss out over into our loss memo. Okay, so over the loss memo, 100,000. And we have a renting for that year as well of 12,500. 14, we have case 1, profit of 6.5, rental income of 12,500, and chargeable gain of €10,000. Is that alright? Yeah? Okay, so we look at our first year, we look at our section, okay, so page 7 again, our first one, section 396A, offset against other case 1 trading income in the current year. So we actually have no other case 1 income, so there's nothing to actually put in there. So you can write that into your last memo if you want, just to show the exam you know that actually been done first. Section 396A, current year, is 0. Section 396A, current year, is 0. So now we need to do a section 396A, prior year. Okay, so our prior year is 2012. So we have 50,000 there. So we can use 100, out of that 100,000 we can use 50,000 inside there straight away. So section 396A. You bring your 50,000 inside your last memo, so you actually have 50,000 left.
That's one of the questions we should try and sheet that in.
Yeah, there might be, yeah, more room. Okay, so that's our first one, section 396A, current year 0, section 396A, prior year, 50,000 off it, leaving with a 50,000 loss to be used. So our third step is to calculate our current year's corporation tax liability as normal. So our current year is 2013. Okay, so we have a specialty case 5 that year of 12,500. With no chargeable gain, so our total profits are 12,500. So what that's case 5 income, isn't it? So that's all going to be at 25%. So our liability for that 12,500 by 25% is 3125. So let's find out from the 50,000 above how much we need of it to shelter this 3125 worth of tax liability. So up to your last memo. Okay, and this is our section 396B, current year, 3125 divided by 0.125, which is 25,000. So to shelter 3,125 euro worth of tax liability, we need 25,000 euro of our loss, which means we've got 25,000 left. So if you come down here, so section 396B, and it's 25,000 by 12.5% is 3125. So we've got a CT liability of 0. As you see it's 12,500. The tax, the case 5 was 25%. So you're obviously going to need double that to actually get rid of it at 12.5%. Just another way of looking at it. Okay, so that's our current year. So we have 25,000 euro worth of loss left now. So we can go back to our prior year and calculate our tax liability as normal. So we've got 2,500. Our charge again is 4, giving us 6,500. So our charge again is going to be at 12.5%, isn't it? Okay, so we have 2,500 by 12.5%. Sorry, 4,000, isn't it? By 12.5%. Our charge of gain, which is 500 euro, and then our other one is 2.5 by 25%, which is 625, which gives us 1125 of a liability, isn't it? Okay, so we need to find out now, out of that 1125, do we have enough loss left to shelter that? So back up to your last memo. So section 396, section 396B, prior year, and it's 1125, isn't it? Divided by 0.125, which is 9,000 euro. Which means we have 16,000 left, don't we? We need 9,000 now for our prior year to shelter 1,125 euro worth of corporation tax liability. by 12.5% is 1125. So our CT liability for that year is 0. Okay, so we actually have 1 year left now, 2014. Okay, so aside from 2014, we've got a case for a profit of 6,500. Okay, it's the same trade from which our loss previously came. So we can offset 6,500 out of this 16,000 against it. Okay, so section 396A. Sorry, section 396(1) of 6,500. Okay, so section 396(1) minus 6,500. Which takes the full case 1 out of that. And the loss we've left in here, 9,500, that's carried forward to future years. You can't write it off against your other income in that year. It has to be carried forward.
You still calculate the
Yeah, we still can calculate CT liability, yeah. We just don't leave it, we do it all the way down.
So you'll be doing it next year if there's still a loss, so you go back.
Yeah, so
It was
like,
lost in 2015 now, did you go off that?
yeah, it was lost in 2015,
Yeah,
come
but it has
back.
to be future loss.
You have to have a current year
You can't
loss.
use that loss, yeah.
No, you
so
can't
that's
use,
it.
yeah.
So lost 15 or 16, you can write off.
You could write off the 12.5 there, yeah. So that's carried forward to future years of the same trade. Okay, so we're just calculating now our 10,000 here. That's our only income there, isn't it? No, we've what? We've 12,000 above it, haven't we? So we have 12,500 plus our 10 is 22,500. Okay, so that will be, our 10,000 is going to be at 12 and a half, and our 12,500 is going to be at 25. Okay, so 10,000 by 12.5% is 1,250. And then 12,500 by 25% is 3,125. Don't know any Italian or Spanish next door for their, I'm not sure what it is. Okay, so that's our CT liability of 4,375. It's not too bad, isn't it?
Oh, it comes back to you afterwards.
Sorry?
It comes back to you afterwards.
After a while, yeah. Have you got this part? No, which part? Will I go over further?
Okay, you don't finish it home.
There's no budget if I take down the figures. I'll go over there to the last memo so you have the. I'll just do one more then, just to have one more practice. So if we went to look at the alpha one here, the next one. further for you?
So when it says gain as adjusted,
That's your chargeable gain. So it means it's been adjusted and it's been done by 33 over 12 and a half. You work out your capital gains tax
okay.
and you multiply it by 33 over 12 and a half to get it for corporation tax.
So
Well-
once it says adjusted, you don't.
You don't have to entail switch it, yeah.
If it didn't say adjusted,
You have to make a decision in whether the question didn't say it was adjusted or whether you should adjust it. So you tell them,
Assume it's just.
assume it's adjusted.
They specifically say not adjusted if
They'd
they want
have
you to
to,
do
yeah.
it, wouldn't they?
Yeah, they'd have to, yeah. Yeah, okay, so do the alpha one there next. Okay, so we have 30th of June 13 and 30th of June 14, and it's the 14 one there, the 50,000 is the loss. I know the minus on side is very small. Okay, so that means 30th of June 14 is our current year, 30th of June 13 is our prior year. Okay, this is called alpha limited.
Is the one with the minus always the current year?
Yeah, wherever the loss is happening, that's always going to be your current year. Yeah.
You just kind of work from that year to.
Yeah, so you take your current year for your loss and you go back to your prior year then, and then you go your future year. So just, if you up over it when you start, just makes it easier to know where you're going into and from. So alpha limited. So I've got 13 and 14 in this one now. Okay, so I've got Schedule D, Case 1. It's item 13 of €10,000. It's item 14, it's a 50,000 of a loss. So 2014, I have a loss of 50,000. I bring my 50,000 loss into my loss memo straight away. Then I've got case 5. And I've got a gain adjusted in each of them of 5,000 and 4,000. or first one, 2014, so section in current year, section 396A, against another trade, so there's no other trade there, so there isn't. Section 396A, current year will be 0. Then section 396A prior year. Let's go back to 2013, so that's 10,000, isn't it? So section 396A. Okay, so you get 10,000 off straight away. Okay, so bring your 50,000 minus your prior year 10,000 off of it, and you were left with 40,000 worth of loss. So now we're going to calculate our tax for 2014 is normal, so we've no other income to make our total income. And we've got a charge of gain of 4, so our total profits are €4,000. We haven't? We're doing this one?
No.
No?
Just 4,000 is it?
4,000. And that's a charge and a gain, so it'll be at 12.5%, which is €500. Okay, so we will need to do a section 396B. Current year. So it'll be 500 divided by 0.125, which goes back up to the 4,000, isn't it? So that's 36,000, which is left. So our section 396B is 4,000, 12.5% is €500, which gives us a CT liability of 0. So that's our section 396B. So we need to go back now to our section 396B for our prior year, isn't it? But first you must calculate our tax liability for that year. So in that case 5 of 500, and we're charging gain of 5,000, giving us a total profits of 5,500. Okay, so we'll have 5,000 at 12.5%. So 5,000 at 12.5% is 625, and we have 500 at 25%, which is 125. Giving us a liability of €750. Yeah?
Yeah.
So do our section 396B now. For a year. How much was it again?
750.
750 divided by 125 is 6,000. We're down to 30,000. section 396B per year is 6,000 multiplied by 12.5%, and that is 750, bringing us down to a CT liability of 0.
You pick the memo.
Oh, the memo, yeah. Okay, and this 30,000 is going to be carried forward to future years of same trade. That's alright, yeah? Yeah? And the next thing I'm going to bring in another one where you have the loss happening in a 9-month period. So if the loss happened in a 9-month or 6-month or 3-month period, you can only bring it back 9 or 3 or 6 months. So you can't shelter all the income from the year before. You can only shelter a portion of it, yeah. But I didn't want to be confusing things too much tonight. Just want to get the basics back into the heads again before we complicate it. So if you go back to your notes there a minute, and just want to just do a little bit of trade charges and non-trade charges. Which are also part of losses. Okay, so we'll go to page 2. Okay, and this is, they call them here excess charges, but they're really known as trade charges and non-trade charges, are deducted from total profits in the corporation tax computation on a paid basis. Excess charges cover the charges paid exceed total profits. Only excess trade charges can be carried forward. Excess non-trade charges cannot be carried forward to the next accounting year. That's important that you can carry forward a trade charge, but you can't carry forward a non-trade charge. You're going, what's a trade charge and what's a non-trade charge? So if we go over to page 8, I've just done a little bullet point thing just to show you what the trade charge and non-trade charge are. So trade charge and non-trade charges. So certain annual interest payments, patent royalties, annuities are charges and are not deductible expenses when computing your tax-adjusted profits. So if you were doing your CT corporation tax thing and you saw patent royalties inside there, you'd have to add that back before you arrive at what your case 1 is. But then you're allowed to claim them further down after. Charges can be deducted from the total profits deducted on a paid rather than an accrual basis. So your trade charges, patent royalties, annuities incurred wholly and exclusively for the purpose of the company's trade. Trade charges are deducted from the relevant trading income. Excess charges may be used against other income on a value basis. They're not used in the year. You can carry forward and use as a section 3961 loss. Okay, so the exact same as if the way you treat a trading loss. If you've got trade charges that haven't been utilised in that year, you can use them again on your value basis and you can actually carry them forward as well. Okay?
What's it annuity?
Joint income tax would be like the covenant, you know, that you pay actually every year. I'm not sure, inside in corporation tax what an annuity would be for a company. Like patent royalties is probably more what they would have, you know, inside there. For patents they'd have on items.
So it's like something you're paying out every year?
Every year,
An
yeah.
agreement of some sort.
It would have to be a legal thing, do you know what I mean, a legal annuity.
already covered as in.
As an example, so you remember it from income tax side.
You sit adjusting in the same way, you go back in again, you divide by
Yeah, so you'd have to do it on the value basis, yeah. Yeah. So what you do is, say you've got your total profits, say were 40,000, okay, and your trade charges were 60,000, and you've made a loss of 20,000 there. So you could use that 20,000 the same way as you used it to just a 20,000 loss.
Okay.
And you may actually carry it forward. Okay, so your trade charges taken off of your case 1 or 2, but then your non-trade charges, which are interest on borrowing used to acquire shares in a loan or loan money to certain other companies, is treated as a non-trade charge, and non-trade charges are deducted from the total profits. Excess non-trade charges cannot be carried forward, and non-used trade charges are actually lost. Okay, and they come up. So we've done our tax here. Over. So where you split it up into total income, chargeable gains, total profits. So your trade charges will come off up here on top. Okay, so we'd have a trade charge inside here under our case 1, but our non-trade charge, because it's non-trade, comes off our total profits figured on the bottom here.
And if your non-trade charges say there over 7,000, but you've lost 1,500.
Yeah, you've lost
So
1,500, but that loss can't be carried forward because it was made from a non-trade charge, whereas the trade charge one above can be carried
So
forward.
you have to use it near its loss.
We've used it near or else it's loss. Yeah.
Okay.
And I have a
You can't bring
question.
it back either, you can't go back here.
No, you can't go back. It's only that particular year. Yeah. It's like little ring fenced really inside that year. Otherwise, companies would be borrowing a load and using this to get out of paying corporation tax. And probably maybe there was a rule further back where that was the case and they found the loophole and closed it up. Okay, if you go back to page 3 there. Okay, so we're up in the top at number 3 there, where in the tax year the company has utilised non-trade charges to shelter its income, as well as using a section 396B value basis claim. The trading losses to be carried forward are to be restricted to the extent that the relief for the non-trade charge was not allowed. Okay, so they're actually going back on it then and saying that the trade charge, they're restricting it inside there if you've used it as a section 396B value basis as well. And the best way to do is actually do a little example. So say company X has a case 1 loss of 500,000 and case 3 income of 100,000 and a non-trade charge of 50,000. Prepare the CT computation and the loss memo. Okay, so let's just do this one here. Okay, so this is XX company. Company XX. I would say it's for 2014 year. So we have case 1 loss of 500,000. So our case 1 loss is going to go into our loss memo. Then it's got case 3 income of 100,000. So schedule D, case 1 is going to be 0. Case 3 is 100,000. Is it 100,000? 100,000. And we've got non-trade charges of 50,000. Okay, so let's work out here. We've got our case 3, which gives us total income of 100,000. Chargeable gains is 0, giving us total profits of 100,000. So after our total profits then, we actually allow our non-trade charge. Okay, and our non-trade charge is 50,000. Okay, so that leaves with 50,000, isn't it? So that's 50,000 by 25%. That's 12,500. 12,500. Okay, so we need to apply now our sections up here. So we have section 3968, we didn't, that was 0 because we had nothing in the current year. We weren't told anything about the prior year, so there's no section 396B is 0. So we're on to section 396, sorry. Section 396A. Prior year. Section 396A. Current year. So we're on to section 396B. Current year, isn't it? And we've got €12,500 worth of a tax liability. So we will see how much of that we actually need to shelter that 12,500. So 12,500 divided by 125, which is actually 100,000, isn't it? Which leaves us with 400,000 of a loss to be carried forward. Okay, so our section 396B, current year is 100,000 multiplied by 12.5%, which is 12,500. So we have a CT liability of 0. So our rule says then that when we're in a tax year, the company utilised a non-trade charge to shelter its income, as well as using a section 396B value basis claim, the trading loss to be carried forward are to be restricted for the non-trade charge, as if the non-trade charge was not allowed. Okay, so we're actually not left claim that non-trade charge really technically, and what we're actually going to do is actually reduce the amount of loss we have to carry forward. So, I mean, it's the same difference, you know what I mean, that if not claim the 50,000 at all and just use a total section 396B, but just kind of complicate stuff by doing it first and then actually disallowing it after that. So we actually have to go back and disallow that. So this 50,000 here, okay, we have to gross that back up. We do that. The trade charge does not exist. So if the Plindis does not exist, what would our liability have been? 100,000 by 25% is 50,000, isn't it? Yeah? No, 25,000, sorry. And then 25,000 divided by 0.125 brings up to 100,000. Okay, so you're pretending that this 50,000 doesn't exist. Now, two little zeros. And then 25,000 divided by 0.125.
To be double, because It's 12.5 from 25.
200,000. Okay? So as if that didn't exist. Okay, so 100,000 by 25% is 25,000. Then 25,000 divided by our 0.125 would mean we needed 200,000.
Did you do that in the last memo?
Yeah, I will, yeah. I'm just doing it there just to show it for an example.
But if you were doing it, like, would you write it in the last memo, would you just write
Yeah.
what you need?
Yeah, I actually even write it across that if what the note I have here is if the trade charge did not exist, what my tax liability would have been. Okay? So if I write that across the top of it, if trade charge, non-trade charge, had not existed, my tax liability would have been would have been 25,000, and I would have taken 200,000 out of that loss. But what did I actually use? 100,000. So I must add back, or sorry, take off another 100,000 off of the loss. It doesn't make sense, do you know what I mean? It's just like, it'd be just easier to just do it this way, wouldn't it? But it's just in there, you have to show it done like that first, then you have to show it going back and do it
It's
like
just
this.
to slow the trade charge after you've used it.
After, yeah, because you can't use a
Yeah.
non-trade charge and
Yeah.
use section 396B loss as well.
So you're just using non-trade charge and then you're reversing what you got.
Yeah, out of it, yeah. So you take 100,000 now out of your losses above. And it's called your non-trade charge restriction. Which is 100,000, which brings our loss down to 300,000. Which that would have been what it would have been if we'd done it without the non-trade charge.
Yeah.
And that this is the inputs and ends in tax.
So that's your
So
section
your
396.
balance carry forward is 200,000.
Your balance carry forward is 20,000, yeah. So if you've got a non-trade charge and you use section 396B loss relief here as well, you can't use both. So you have to actually restrict the amount of the loss. So you're actually taking off more loss here.
Just, if you had no loss,
If we hadn't the non-trade charge, we'd have used 200,000
Yeah.
here anyway.
but
So
then
it's
if you had a loss of 400,000, if there was no loss there at all,
If there was no loss there
the
at all,
trade charge
the
stands.
trade charge stands then, yeah.
Ah,
Just take
okay.
50,000 off, then you take the 50,000 off of
Yeah.
all your income.
Yeah.
Yeah, and you utilise, you've got a non-trade charge then, say, as you said, like, pretend there was no loss there. Okay, there's that there. So let's pretend there was no loss. There was actually a 500,000 profit, wasn't it?
500,000 loss, so yeah.
So we'll change that now and make it to the 500,000 profit. Okay, just say it's a 500,000 profit now instead. And exact same, our case 3 is 100,000. Our total income then is 600,000. Charge again 0, giving us 600,000 here. Our non-trade charge is 50, bringing us down to 550,000. 550 yes. And thinking about this non-trade charge, because it's a non-trade charge, you put it against your non-case 1 income first. Okay? So what's our non-case 1 income? It's our case 3. So we'd have 50,000 at 25%, which is our 12,500, and we'd have the 500,000 at 12.5%.
No. The way around, is
It's
it?
62,500.
That'll be the way around now. 500,000 is your trading income.
Yeah,
Trading income to 12.5.
12 trading income is 12.5.
Yeah.
And our rent is at 25%, but you use a non-trade charge against your non-case 1 income first, so your investment income first, because it's non-trading. And then you, whatever, say if the non-trade charge had been 100,000, then you would get totally, we'll go 150,000 we'd say. Then you get totally rid of that 100,000 and you take 50,000 off of there. So you go to your case 3, 4 or 5 first with your non-trade charge and then anything else against your case 1 or 2. And they can be hard, those ones, but I will bring in more questions on those trade charge and non-trade charges for the next night. But like that rule just totally, do you know what I mean, just you're better off actually ignoring the non-trade charge there and just calculating it as if it was a normal section 396. But for an exam point of view, you have to know that you know the rule. You know, okay?
Very well, like you should
Yeah, in real life you wouldn't. Yeah, but in exam life, we're in different thing, we would do it. Okay, just go through a bit more of the theory and then have a break and then do other corporation tax questions after and finish our losses on the next night because you'd be totally sick of losses otherwise. Are we? Us 10 so we're grand. So page 3 is a terminal loss. So a terminal loss, when a company ceases trading and sustains a loss in a trade in the last 12 months, the company may claim to have the loss carried back against income from the same trade in accounting periods falling within 3 years preceding the last 12 months. So a terminal loss, it happens in the last year you're trading. You can actually go back in the previous 3 years and claim it against that same trade. Okay, you can't put it against your other income, you know, you put it against your same trade. And we'll be doing these the next night on terminal losses, because they come up in a nice bit, terminal losses and group losses in the actual exam. Then there's a loss restricted on change of ownership. It's section 401 anti-avoidance legislation, where there's a change in ownership of a company and then over a 3-year period there is a major change in the nature and conduct of the trade. At the date of sale, and the scale of activities has become small and negligible, and there's been considerable revival in trade only after the change in ownership, the carry forward of losses incurred before the change of ownership may be denied under section 401 against income of an accounting period ending after the change of ownership. So what it is you've got company X and company Y, okay? So company X has massive losses, say of 200,000 or 300,000. Okay, and company Y buys them because of these losses. Well, company Y can't use those losses on the first year they actually buy it. Yeah, you can't just buy a company to use the losses. They're actually ring fenced. But then, if say the year they bought it, say they sold it in 14, right? 2015 they made a loss. Okay, well they can use that loss then against their other income, but the 200,000 they had from the year before they can't use. Then we come into 16 and there's a major upturn in this, and the same for the next 3 years. Then they can actually start utilising those 200 losses after the 3 years.
They can use the old losses for 14.
Yeah, you can use the old losses for 14 after you've got the revival for 3 years.
So you can bring other company losses, other companies that you buy, you can bring their losses forward after the 3
After
year
the 3
period.
but there has to be a revival in the trade first. Yeah,
So
yeah.
full profits basically.
Yeah, it has to go into profits, yeah. So I have that, if you want to see down that little example, I have it here. So X had losses carried forward of 200,000 on the 31st of December 13, we'll say. Okay? So X had losses, I actually write it up here so I don't have to do it again. Okay, so this is our change of ownership. Okay, so loss restriction. On change of ownership. Okay, so an example we have here. X had losses carried forward of of 200,000 at the 31st of December 13. Y bought X in 2014. And made a loss of 50,000 in 2014. In 2015, there was a major revival of the trade, and X made profits of 75,000. Okay, so in 2015 it was a major revival of trade, and X made profits of 75,000.
X made profits or Y made profits?
X.
X, so it has to be the
Yeah.
trade that you buy.
It has to be the, yeah, X itself. Then the 50,000 loss in 2014 can be used the 75,000 profit in 215. So that last time is about 2105 to 104.
Going forward into
It can't be used until.
That one could be used straight away because in
Oh, yeah.
14
Yeah.
it wasn't the loss going forward, it was made, that loss was made in 14.
As you know,
Yeah. And then they can use that inside in 15. 50,000 loss in 14 can be used against the 75,000 profit in 15. But the 200,000 loss is carried forward and is restricted for the first 3 years. And then after the 3 years, they can use the 200,000 losses brought forward from 2013 against those profits. It's like it's an anti-avoidance clause in there to stop them just buying the 200,000.
company just
Yeah, just write off losses. Yeah.
So if you see the economy picking up, buy up all the crap companies now in 3 years' time.
Okay, well, the losses.
Yeah.
When you're making nice money out of it again. Okay, then we have our case 5 losses on the bottom of page 4.
Sorry, just a part of that loss, say Y bought X in 2014 and they made a loss of 50,000. Part of that loss could be because they bought company X. Does the cost of that come out of the thing? No.
Oh, the cost of that wouldn't go into it, so that would be like used as a capital, like an asset. You couldn't actually claim it. Yeah, it'd be like when you're.
But that wouldn't contribute to the loss.
No, that wouldn't contribute to the loss,
Trading.
no. A trading loss, yeah. So the bottom of page 4, we've got case 5 losses. So just look at the second bullet point first. Case 5 losses set against other case 5 income the same accounting period, set against case 5 income for the immediately preceding period of the same length, and carry forward against future case 5 income, okay, which I just said earlier on, okay? So you can go back into case 5, but it's not compulsory, do you know what I mean? You can just carry, it's not compulsory to go back. Whereas, you know, in our section 396 AA and BB, you have to go back and forward. But for this one, the case 5, it's not compulsory for you to. You can actually hold on to it and just until you start making a nice profit and carry it forward. Then the one above it is an interesting one. Excess case 5 capital allowances, and we're talking about industrial buildings. So set against total profits of the same accounting period, set against total profits for the immediately preceding period of the same length, and carry forward against future case 5 income. And if I'm writing here, it's not on the value basis, it's on a euro for euro basis.
So was it?
It's not on a value basis, just for those case 5, excess case 5 capital allowances. It's on a euro for euro basis, not a value basis. And so there you can actually put it against your total profits, which is a big thing you could actually save on. Do you know what I mean? You can take all your income, like if you had an industrial building that had high capital allowances on it. Then on top of page 5, you've got case 3 and case 4 losses. Okay, so case 3 losses would be like your foreign rental income, your foreign trading income. They're actually ring fenced. Okay, they can only go against case 3 only. Okay, so case 3 only against case 3. And then in case 4, I don't know where you're going to have a case 4 loss. So case 4 is your deposit interest. I don't know where you'd have you're not going to have a minus deposit interest, hopefully anyway. But that is ring fence as well.
Only against itself.
Only against, if it does come up, yeah, it's ring fenced as well. So case 3, case 4 and case 5 are ring fenced off each other. And the only thing case 5 then it can actually be used against other income is if you've got the case 5 excess capital allowances for your industrial buildings, then that can be put against your total profits. And you see late filing your returns, then there's actually a restriction there if you're late filing your returns. So where the return is less than 2 months late, there's a 25% restriction of the losses up to a maximum of 31,740. And where the return is more than 2 months late, there's a 50% restriction of the loss up to a maximum of 158,715.
Unless it's 25% restriction, that means you're allowed 75%.
You're allowed, you would take off. So say your loss was 10,000, you can only 7.5. Yeah, you're losing 2,500 worth of loss there. And like in 50%, you're losing 5,000 worth of your loss, which is costly. Like for, do you know what I mean? Make a big difference in if you're a big company. The next question there, beta then, I'm going to do that. I want to start that the next night because it has all the case 5 and all the case 5 capital allowances on it. But I'm not going to do it tonight now because it'll be the losses. And then the last one there, the one on page 6, is a terminal loss, a case 3 loss, a case 5 loss, and a case 5 loss for capital allowances. So it's got all the losses in it. So we'll start with those 2 on the next night. But if you wanted to be brave and look at them, but I'll be doing them in the class anyway. And then we'll be doing, see on page 10, I'm going through group losses as well. Okay, how you can actually transfer your group losses between the companies and what are the rules that actually apply to it. Okay, so we take 5 minutes there and we'll come back then and do some different corporation tax questions. Okay.